Are you ready to tap into markets with some of the highest growth potential, but aren't sure where to start? Well, emerging markets might just be the opportunity you're looking for. But with great returns come great risks. In today's video, we'll explore how to invest in emerging markets, manage risks, and diversify your portfolio like a pro. So, if you're curious about what it takes to thrive in these dynamic economies, stay tuned. Number 1. Understanding the risks. Investing in emerging markets presents unique challenges, with risks ranging from political instability to economic fluctuations and currency volatility. These markets tend to be more volatile than developed ones due to factors like political unrest, economic instability, or natural disasters. Sudden gains or losses are not uncommon, and events such as political uncertainty in Brazil or trade tensions involving China can lead to sharp market corrections. Currency risk is another major concern, as emerging market currencies often fluctuate wildly against the US dollar. Even if an investment grows in local terms, currency depreciation can erode returns when converted back to the investor's home currency, as seen with the Brazilian real. Liquidity risk also plays a significant role, as these markets may lack the liquidity of developed markets, making it harder to buy or sell assets without affecting their price. This risk is especially pronounced in smaller markets with fewer active investors, where large transactions can lead to unfavorable pricing, particularly during times of market stress. Number 2. Diversifying your portfolio. Diversification is a crucial strategy for managing risk when investing in emerging markets, as it helps mitigate the impact of downturns in any single region, sector, or asset class. Geographic diversification, for example, involves investing across multiple emerging markets rather than focusing on one country. This approach spreads risk, as political instability or economic difficulties in one region may not affect another. While China might experience rapid industrial growth, Brazil could face a recession, so diversifying geographically increases the likelihood of benefiting from better performing markets. Similarly, sector diversification plays a vital role, as emerging markets encompass various industries with different risk and return profiles. For instance, the technology and consumer goods sectors in China and India might show substantial growth, whereas Russia's energy sector could face challenges due to fluctuating commodity prices. By investing in diverse sectors, investors can offset the risks associated with any single industry. Moreover, asset class diversification adds another layer of risk management. While stocks in emerging markets offer high growth potential, bonds provide more stable, fixed income returns, and commodities can act as a hedge against inflation and currency risks. A portfolio that includes a balanced mix of stocks, bonds, and commodities is essential for navigating the volatility and risks typical of emerging markets. Diversification across regions, sectors, and asset classes enables investors to spread risk more effectively, ensuring they are better positioned to capitalize on opportunities while cushioning potential losses in unpredictable markets. Number 3. Choosing the right investment vehicles. Investing in emerging markets offers several avenues for exposure, each with its own set of risks and benefits tailored to an investor's risk tolerance and desired involvement. One popular option is through exchange-traded funds, ETFs, and mutual funds, which allow investors to access a diversified portfolio of stocks or bonds from multiple emerging markets. For example, an emerging market ETF may include companies from Brazil, India, and South Africa, reducing the risks associated with picking individual stocks. These funds offer a more passive approach, making them less risky than directly investing in single companies. However, investors should be mindful of fund fees and the specific markets they target, as some may focus on riskier regions. For those with a higher risk appetite, investing in individual stocks presents the potential for greater rewards but requires thorough research. An investor might choose to buy shares in a Chinese tech company or a Brazilian mining firm, expecting strong growth, But individual stocks carry company-specific risks like mismanagement or fraud, which can result in significant losses. Lastly, emerging market bonds offer fixed income returns with higher yields than those from developed markets, compensating for the increased risk. While attractive to income-focused investors, these bonds are exposed to the same political and economic volatility that affects other emerging market investments. Default risk is higher, so careful evaluation of the creditworthiness of the issuing country or company is essential. Overall, whether through ETFs, individual stocks, or bonds, emerging market investments require a careful balance of risk and research. Number 4. Currency. Hedging strategies. Given the risk of currency fluctuations in emerging markets, hedging currency exposure can be a strategic approach for investors looking to protect their investments from unfavorable exchange rate movements. Currency hedging involves using financial instruments such as currency futures, options, or ETFs that track currency movements to mitigate the impact of adverse currency shifts. For example, if an investor holds significant assets in South African equities, they might implement a currency hedge to offset potential losses in the value of the South African rand. This strategy helps safeguard returns by ensuring that currency depreciation does not erode gains made in local markets. While currency hedging can be particularly useful for investors concerned about short-term volatility, it does come with its own set of challenges and costs. The expense of implementing hedges can eat into returns, especially when using complex financial instruments, and not all investors find it necessary. For long-term investors with a diversified portfolio, currency fluctuations may balance out over time, making hedging less essential. However, for those with a shorter investment horizon or concentrated exposure to a specific emerging market, hedging can provide a valuable layer of protection. It's important for investors to weigh the potential costs against the benefits and assess whether their portfolio's exposure to currency risk warrants the use of hedging tools. Ultimately, currency hedging offers a way to manage risk, but its necessity depends on the investor's time frame, risk tolerance, and market outlook. Number 5. Conducting thorough research. Staying informed about economic, political, and social developments in emerging markets is crucial for investors, as these markets are often more sensitive to changes in leadership, economic policies, and social unrest compared to developed markets. A change in government leadership, for example, can lead to significant reforms that directly impact businesses or trade policies, potentially influencing market performance. To make sound investment decisions, it's essential to stay up to date with the latest news and developments in the countries where you are investing. Monitoring global economic reports, news outlets, and market analysis from reputable sources can provide critical insights into the factors driving these markets, allowing investors to anticipate risks and opportunities. Regularly tracking political developments, economic trends, and social movements can help investors navigate the complexities of emerging markets, where changes often occur rapidly and can have far-reaching effects. Additionally, consulting with a financial advisor is a smart strategy for those looking to invest in these markets. Emerging market investments can be complex, and a financial advisor can help tailor an investment strategy that aligns with your risk tolerance and long-term financial goals. Advisors can provide expert guidance on market conditions, recommend appropriate investment vehicles, and suggest risk mitigation strategies, ensuring that your approach to emerging markets is well-informed and adaptable to changing conditions. Whether it's navigating currency risk, political instability, or economic fluctuations, staying informed and consulting professionals can significantly enhance your ability to manage the unique challenges associated with emerging market investments. Investing in emerging markets can be a thrilling ride, but it's all about being informed and staying prepared for the bumps along the way. If you found this guide helpful, make sure to give this video a thumbs up and subscribe for more insights on smart investing strategies. And remember, the key to success in emerging markets is patience, discipline, and diversification. Thanks for watching, and we'll see you in the next video.